Well, welcome to this week's episode of the Decarb Connect podcast. I am joined by Caroline Abramo, the Chief Investment Officer of Pana Low Carbon Private Equity. And Caroline, you and I first got introduced, I think it was sort of late 2020, but welcome onto the podcast episode. Why don't I get you to kick off with how you've arrived at this point in time where you're on the Decarb Connect podcast. So we're going to be talking about what clean tech looks like post-COVID and post the kind of announcements, the early announcements of the Biden administration. So tell the listeners a little bit about how have you got to the point in time where this is your focus?
Alex, thanks so much for having me. It really is a pleasure because I really think that we are at the tipping point for everything low carbon and a lot of just great momentum just for the global economy. So what brought me to this point is really a 30-year career in traditional infrastructure, commodity infrastructure specifically. And really what I see is as really just the next revolution, for that and for, the infrastructure that we have globally that's focused on, energy, on agriculture, on real estate. And it was really the imperative to get investments made today, and to really highlight that there are technologies that are ready to be commercialized that can absolutely upgrade our supply chains and upgrade our infrastructure. So part of the mission is an educational mission. The other is just is really using my experience as a fiduciary and an investor to help other investors to come into the space.
And a little on your background, I know I saw on your profile that, I think you've worked at sort of three of the biggest investment banks in there. Was it all in natural resources or energy? Is that right? Just give us a little bit of the background, because obviously now it's low carbon focus, but you've come from kind of industry infrastructure focus. Am I right?
You're right, Alice. So I actually started as a natural gas trader almost 30 years ago, and then moved into banking. And you're right, I worked for several large European investment banks, Credit Suisse, BNP, actually, and prior to that, Deutsche Bank, and prior to that, Bankers Trust. So I definitely was at the very forefront of energy transition then, which was really about moving to natural gas from coal as one one really important industry shift, and as well being at the forefront of the traded markets for commodities, which were really nascent then. The WTI contract and the natural gas contract on the NYMEX had really just been launched in the mid 90s, and that's when I started. So it was an absolutely exciting time to be in the market, and really for technologies that have actually come through in the last 30 years. We had the shale revolution in the U.S. We had the power generation or the power evolution towards renewables, towards solar and wind. And, I got a front seat to that and to really fund the companies that were at the forefront of that. So it's been exciting.
Interesting that obviously those transitions between different types of fuels had their own, I'm sure, their own tensions or whatever, but you're kind of well prepared, I guess, for this next big transition. You've seen elements of this before, maybe not on this kind of scale or the speed of transition, but the kind of the mechanisms and the elements of change are something you're familiar with.
Yeah, and I think, and that's a really astute point, Alex, is an essential part of how Pana has formed itself, and the partnerships that we have with corporations and with government, is we see that the corporations, and especially in the traditional fields in energy, have this experience. They have this very experience to make these large scale shifts and to deploy this technology, and it's imperative that we work as a community to actually get this as the next phase. They're done. You rightly put this, the magnitude of this shift we have never seen in our lifetimes, and it is the opportunity, frankly, of our lifetimes.
Well, let us go back to this the kind of theme that we'd talked about when we had our catch up the other week, which was really looking into what the clean tech market looks like now that we're kind of exiting, we hope, this period of COVID, and now that we're starting to learn more 6 months, 7 months into the Biden administration about where they're really going to be putting their policy punch, like what they're pursuing. Tell me from your perspective, what looks like it's going to change, and what are we going to see? What do you expect to see, in the short term as well as in the longer term?
I think, I mean, there's a balancing act that's going on for the Biden administration and for the U.S. Generally, and I think it's really where we sit in terms of the trends that have been emerging, mostly in Europe, where Europe has really taken a leadership role in decarbonizing all of our industries. But I think the Biden administration has done a good job so far into thinking about how to upgrade existing infrastructure and make sure that we maintain existing jobs. And those are in our existing industries. It's taken 30, 40, 50 years, maybe 100 years to get to where we are. So it's not possible to say, to switch on a dime and say, well, everything's going to look different and we're going to have to build a lot of things. We're going to have to do that too. But we absolutely have to maintain what we have and upgrade them and really think about that. I think the Biden administration is doing a good job of that so far. And in the same breath, is that creating the right incentives and spending the right amount of capital to full scale build the things that we need and upgrade that technology and that infrastructure. So he's definitely put the pedal to the metal in terms of that. And I think as with all government policy, it takes some time to kind of work through. So the incentive part of it will probably take some time, and which is why I think we really need to depend on corporations and the private sector to pick up while this transition is happening, knowing that we have a huge tailwind with the government, moving in this direction.
One of the things that we hear a lot at Decarb Connect, obviously we're talking to the industrials in this mix, obviously with investors like you two, but the industrials are really kind of front and center of our focus. And so you've already mentioned one thing that comes up a lot, which is, again, we're not necessarily anti this work, we're not sort of denying the science. We are asking, as industrials who provide millions of jobs and contribute billions, trillions to the economy, how to do this whilst maintaining a global or national competitive position. When you're outside of it, you're kind of like, oh, just get on with it. But once you start talking to these companies, you're like, that's not an unfair position to take. How do we do this without blowing up part of the economy that maintains a large part of the workforce? The other thing we hear a lot, though, is that they have a very long timeline. And so I'm interested in this from your perspective, because investors, depending on fund, have very different scales of timelines.
Yes, that's a great question. So we frame up to the Paris Accord goals of 2050, that were introduced in the initial COPs, where we're not raising surface temperatures by more than 1.5 degrees. And that leaves us a 30-year runway, which I thought was kind of an interesting perspective just on that, in terms of matching it with what you rightly put is really like the corporate planning cycle and how long these things actually take to get done. But interestingly, it actually gels beautifully with the investor timeframes that folks are looking for. So most large-scale infrastructure investors are looking at 30 years plus, and they actually often complain that their funds available in the market, or the way they could deploy capital, is, or investors are saying, 10 years is not enough. Like, we want a 20-year fund, which is, there's several things going on there. And you have a lot of long-term capital deployers, like pension plans, like insurance companies, that absolutely want that profile. I mean, when you look at infrastructure, you look at steady yields, you look at a lot of things and attributes that are very stabilizing in portfolios for investors. So they're very interested, in having, this kind of focus and having more capital being put into these kind of projects, and these kind of companies. There are those that are shorter term focused. So for those in mind, so let's say the next 5 years or even the next year, interestingly, we've got a hugely accelerating market, mostly in the States, for public market companies. So companies that were private, they are moving quickly towards either a traditional IPO or a SPAC vehicle. And that is really the marketplace, that the public marketplace, saying we don't have enough sustainable companies. We don't have enough companies, doing this yeoman's task. And we want to accelerate that. We want to give them the capital to do the next, 4 or 5 projects. That is materialized. That's happening today. We have no less than a half a dozen companies in our pipeline that are potentially looking at that as a financing vehicle, and that will come to fruition very quickly. So I think you have a lot of space for different types of investors, along this journey. I think, in general, we have the technologies that are ready to be deployed, are ready to come to these, quicker market scenarios. And then we have those that need to be incubated that potentially will not be ready for market for a decade or so. And we need to invest in those too.
Okay, so within that, with that kind of investor arc of people, from very kind of quick-fire venture stage through to massive public market fund stage, how do you articulate those to people that you're investing in or who are looking to bring funds to you?
Yeah, Allison, so we would characterize ourselves as private equity, and growth equity, if we have to pick a spot. And I think we are fulfilling a needed financing route, where a lot of these technologies they've been de-risked in terms of that they work. So their seed capital, their venture funds have taken them up to that level. And then they're now looking to commercialize. And so they very much need teams that can come in and help them and introduce them to corporates, introduce them to, where incentives would make sense in terms of their financial models. That's where Pana is playing. So where we pick up our companies is really late stage venture and help them to grow. So where they would then be considered an infrastructure investment. So they have their first 3 or 4 projects done under their belt, and then they would be available or ready for some of the, the bank financing, some of the, the green bond issuance, some of where there is a lot of capital sitting and where there's comfort in terms of risk and return. So we are very focused on this, what I did not coin the term, but some of our companies coined the term the valley of death, where this is where it's very critical for these companies to get equity capital, and equity capital to keep accelerating their technology, but also to seed the first projects that they're going to deploy that capital, that technology into.
And as a business, like the stage you're at the moment, so what sorts of investments have you got in play?
So in terms of our portfolio, so the sectors that we're looking at, we think that are right now deployable into the market are in the waste to value sector. So we're doing a lot in terms of the transformation of different waste. Plastics is a huge area that we're looking at, and creating a sustainable packaging goods or materials that can be used, fuels or solids that could be used for that almost endless demand by the consumer markets, to have non-fossil fuel-based packaging. So that's an area that we're really filling out. Our thesis is to continue to make investments in a space and maybe look a little bit earlier stage when we can, after we make our initial investments. So that's one that we've made several investments in. Baseload power generation is another area that we've made several investments. Both from just the concept that I think a lot of investors are comfortable with or understand the limits of solar and wind in terms of their intermittency. So the fact that they only work when it's sunny or windy, and but power generation needs, or the needs of consumers, is 24 hours a day. So we need to store them. So all manner of energy storage in terms of batteries, non-battery solutions, other base load types of power generation like geothermal we're looking at. We've even looked into nuclear, as many parts of the world are very interested in that, have that in the mix right now, and even in places in the US.
This year, actually, more and more what we're hearing from industrials is, but what can I do now? What can we do now? So there's a lot of interest in those areas that you've talked about. So waste to value, definitely distributed storage, and also what else do we keep hearing? I guess actually the kind of the less sexy area of just plain energy efficiency, whether that's through good digital data usage and things like that. But it's interesting, it felt like when we first started working in these sectors, it was about those big tech, big kind of hardware, big plant scale additions that they might need to make. And right now it's kind of almost shrunk back to, right, those are great, but what are we going to do in the next 2 or 3 years to start moving the needle? But it's interesting. I mean, obviously we're on an audio podcast, so the listeners can't see you, but you're obviously very passionate about this space and about the work that you're doing. So what is it that made you make this shift from the kind of energy and commodities, which is obviously part of this picture, but into low carbon? What was it that sort of pushed that final decision to launch Pana?
Is really the availability of the investment opportunities. It really is the investment opportunity that I think is the biggest that I've ever seen in my lifetime, and I think most of us will see. So it was really, just an excitement about continuing to grow with the industries that I've always loved and been a part of. So to me, it was pretty natural. Coupled with, though, the fact that, as a steward of the earth and the environment my whole life, is that we needed to get busy, and I felt that was a good use of my time, and hopefully to work with investors, but also friends and family, to really get those messages out. So for me, it was pretty natural. And I guess also to have, a business that is nimble and actually can move quickly was very important. And have a lot of humility and a lot of thanks for the institutions that I've worked with that have set the stage for our professionalism as fiduciaries. But often it's hard to get things done, when in a larger moving organization with a lot of history. And I thought that was important with Pana to set the stakes and set our investment process out to be fresh. And to look for these two important pillars of return, but also climate reduction, and I would say, Alex, as well, the other pillars of ESG. There's other pillars in E besides climate, so other environmental factors, but also the S and the G. So interestingly, in our investment process, we don't get to talk as much about diversity and social governance, but it is absolutely, it's intrinsic to our process. So we're finding a lot of companies that are meeting those standards. So it's very exciting. So a lot of it is being able to enact those things quickly and build.
Well, one of the, that kind of leads nicely, actually, those ESG factors into one of the areas of, I guess, contention or discussion or something in the last, feels like particularly in the last 12, 15 months, has been like, to what extent is there a tension between a fiduciary duty to an investor versus this kind of duty, or whatever someone may perceive it as, to climate? And I'm wondering, like, what does that mean to you? How do you address that? Because obviously it was something, not just the previous administration in the States, but it's the world over, people are talking about that. Like, what is the balance of those responsibilities? So how do you conceptualize that? How do you think and sort of talk to people about that?
To me, Alex, it's all about risk management. So, I view our job first and foremost is to de-risk the investments that we are putting in front of our investors, and to really classify them or create a framework. And I think when you do that, then the space becomes a lot more open. I think you rightly put in terms of just the timing to market, which technologies are most ready, just in terms of their commercial readiness, but also how then you would model in that readiness. So essentially creating a financial model that looks like any other company that investors would look at. Now there's complexity to it, or there's additions, which are things like incentives or premiums for the products that they sell, so be able to create more revenue. But when you get that down to a common financial language, then that it becomes just, again, like everything else for investors. And we take that very seriously at Pana. So I think it's really the marriage of just, kind of the environmental movement meeting, mass finance. And I think that's where we are today. I think that's what we need. And I think that, I don't just think, I know that you can achieve market-based returns and also, reduce a lot of carbon. So I don't think they're mutually exclusive. We believe that they're consistent. And I think it's the way you frame it, obviously the way where you're sourcing the opportunities, and how you're thinking about, the time frame, in which you can deploy them.
The other aspect, I guess, of all this that also has had a bit of, I suppose, has come under the microscope a bit more, is also what ESG, or what that kind of approach of focusing on environmental performance really is achieving. I know we had a speaker from Massive Capital to our event in January who was talking about that, and even in the news not that long ago, BlackRock's former chief investment officer was kind of pointing to something similar, which is, there's a lot of kind of interest in exploiting the E of ESG, I think was that kind of key phrase that he was using, but that actually driving real change in the environment may not always drive the same. I don't know, I guess there's this question of, is it going to drive the same kind of return as people are used to? Again, what's your perspective on that?
I think the timing to market is different, and you rightly put for some things that you've also focused on the show of, of hydrogen and carbon capture, and that this is where we're looking for government to kind of catch up, to actually where the technology is, but provide some incentive to investors to come in early. So, in order to to de-risk it. I think that part of it too is just the very nature of the type of technology investment. So, and you rightly pointed to a very large vertical, which is more of the kind of like systems-based AI type monitoring type technology that is very much needed, but it's what I call asset light. It doesn't involve in being deployed into, big projects that are going to cost a lot of capital. So, CapEx, I guess, versus OpEx. And I think marketplace is more comfortable with, this more systems-based, not asset-like approaches. And so I believe, though, when you think about the returns of the marriage of that, then, you'll see that there's proper returns for each of the stages of each of those types of technologies, and even in their evolution. So I think it's a much bigger topic when folks say, listen, returns potentially could be inconsistent, with a higher level environmental obligation. I think there's a space for a lot of investors in all of those spaces as we look out over time.
I guess the other thing that we see is also that many of these funds do extremely well, like they are performing extremely well, but again, then there's an additional criticism of that but are they focused on the things that are going to make game-changing moves in the climate space, or is it rewarding companies that can easily push off responsibility for their carbon dioxide or other emissions further up a value chain? Again, coming back to the industrials, I sort of sounding like I'm slightly protective of them. They don't need my protection. They are massive. They can manage their own lives. But I think it's interesting that they are at the kind of the sharp and pointy end of this stick, aren't they? They don't have many other places where they can push off responsibility for emissions. It is what it is. So how do we also make sure that capital goes there and not just on rewarding companies for divesting of that responsibility somehow?
That's really astute, and I think, listen, and you said you were like, they don't need your protection. The industrials, we work a lot with them too. They have a lot of capital and sitting on balance sheets, and I think, and now with the kind of obligations or promises they made to the market in terms of carbon reduction, is that they have to turn around and say, how am I going to upgrade the supply chain? We have to spend some money, and they have the money, which is the good news. So I think that's changed tremendously. And again, a lot of the thinking about the inconsistency of like high market-based returns and an environmental focus has really been that there hasn't been the end user. Like the end user has not been demanding the technology, frankly. And now we have corporations that are absolutely demanding it, and we have consumers that are demanding products from those very corporates that will satisfy their sustainable goals. So I think everything's shifted massively, in the last couple of years. And so when people say to me, how is it different this time? We were around for cleantech 1.0, 2.0. That's the difference. That is absolutely the difference. And we're now seeing that to start to engage. And so I believe that you're going to see higher, you're going to, by very virtue of it, just supply demand. As a commodity person, I say, you just have more demand for it.
And then for you and your investment approach and your lens on this, where are your kind of hard lines or boundaries around whether you're going to invest in companies that aren't yet in that sustainable space to help them get to the sustainable end of manufacturing? I don't know, what's your perspective on how to manage this kind of particular stage of the transition where, yes, there are many companies that you're already identifying where it's just a total no-brainer, absolutely in your sweet spot, but then there's going to be all these other companies around the edge that maybe need that transition. Is that a place where Pana will play, or is that I guess maybe that is that in the mix for your investment?
It absolutely is, Alice, and I think we are not purists in our approach of that. There are some groups and there are some investors say, listen, I only want to focus on investments that are non-fossil fuel driven, meaning that they're technologies that would not go into traditional fossil fuels, meaning in any of their infrastructure and supply chains. We're not in that camp. We absolutely believe, as I stated kind of in the beginning, of the fact that this is the infrastructure that we need to upgrade. So we absolutely need that. And I think, I won't be the first to say, that, we continue to need fossil fuels. And we talked a little bit about Biden, but we also have investors. We have Warren Buffett, who talks about, this transition and the timing that we need. So we absolutely play in all of the technology spaces, because today the power generation stack requires, that we continue to look at some fossil fuels, as well as not just power generation, but in our consumer world. So we have to do what we can today, and there's technologies to be deployed to those very sectors. And again, the companies have the capital to deploy them into that sector. So I think it makes a lot of sense, but marrying that with I would say a goal of looking for a world where we have transitioned, and we are looking more at a lot of things you mentioned, at hydrogen or carbon capture, that those should be invested in, and there's an investor type and there's a time frame in which those are the most appropriate. So essentially, there's space for everyone in terms of the way that they're thinking about these things, because last thing I'll say is it's very personal to a lot of, even if they're institutional investors, there's a lot of emotion that's involved in this, and how you think about this, about if it's the environment, the lives of your children, or your family, or those around you, and so there's a lot of, I guess, personalization that goes on with a lot of these investments.
Well, if we think it's personal in our generation, I guess all of us have a reckoning coming as the kind of people in their 20s and 30s build their own wealth and start to want to deploy that in the market. And it's a whole load more personal and more kind of ingrained, isn't it, I think, in the next couple of generations. So if you're not building the funds that these people can gravitate towards, and if other types of funds aren't being created, then we're all missing an opportunity, I suppose, is my gut feel on it. Lovely to talk to you, Caroline. Thank you so much for joining us.
Thank you so much, Alice. We'll come back and we'll talk, and we'll have some proof in the pudding. So thank you so much.
Thanks for joining me.